Every trader wants to win. Very few want to become consistent. Winning feels good. It feeds the ego. It creates stories. Consistency does none of that. Consistency strips trading down to its most uncomfortable truth. You are the variable. The market is not holding you back. Your timing is not cursed. Your strategy is not broken every other week. Your mind is undisciplined. The consistently winning trader is not the one who predicts the most moves. It is the one who behaves the same way whether they are winning or losing. Calm in profit, calm in drawdown, calm in boredom. That calm is earned through pain. There is nothing glamorous about perfect execution. It is repetitive. It is restrictive. It demands that you ignore impulse, even when impulse feels justified. It demands that you pass on trades you want to take. It demands that you sit still when your body wants action. Most traders believe consistency is something you earn once you finally figure out the market. They think if they can predict price a little better, read structure a little cleaner, or spot the next move a little earlier, stability will follow. That belief keeps them stuck. The market does not reward prediction. It tolerates it at best. Price can move against the best analysis for reasons that have nothing to do with logic. News, liquidity, positioning, timing, none of it asks for your permission. When traders rely on prediction, they tie their confidence to being right. And the moment they are wrong, behavior changes. They hesitate. They chase. They overcorrect. Consistency collapses. Behavioral control does not care about being right. It cares about acting the same way regardless of outcome. Consistently winning trader does not need certainty. They need permission. Permission comes from rules, not opinions. When the setup is present, they act. When it is not, they wait. No debate. No interpretation layered with emotion. Prediction creates attachment. Attachment creates interference. Interference shows up as early exits, missed entries, widened stops, oversized positions. None of these come from the market. They come from the trader trying to protect their ego. Behavioral control removes ego from execution. This is why traders who know a lot often struggle more than those who know less. Knowledge invites prediction. Prediction invites overconfidence. Overconfidence weakens discipline. The market does not care how smart you are. It responds only to what you do. Behavioral control means you do not change your actions because of recent results. A win does not make you aggressive. A loss does not make you defensive. You do not trade to feel better. You trade because conditions align. This level of neutrality is rare. Most traders let recent outcomes dictate behavior. After a loss, they hesitate. After a win, they loosen rules. These shifts are subtle but destructive. Edge disappears not because the strategy failed, but because behavior drifted. Consistency requires sameness, same size, same risk, same execution speed, same patience. The trader who wins consistently is predictable to themselves. They know exactly how they will respond in each scenario because the response is predefined, prediction-focused. Traders want to feel in control of the market. Behavior-focused traders focus on controlling themselves. Only one of those is possible. When you stop trying to predict and start trying to execute cleanly, trading becomes quieter, less emotional, less reactive. The noise fades and what remains is process. Process compounds. Emotion does not. The market will always surprise you. That will never change. Behavioral control prepares you for that surprise by making your response automatic. Consistency is not about seeing the future. It is about responding the same way no matter what the future brings. When behavior is stable, results stabilize over time. Not because you guessed right more often, but because you stopped sabotaging yourself. The trader who masters behavioral control no longer fears uncertainty. They expect it. Most traders believe passion fuels success. They think intensity, excitement, and emotional involvement sharpen performance. In trading, the opposite is true. Emotion blurs execution. Perfect execution does not come from energy, it comes from neutrality. Emotional neutrality is not indifference, it is control. It is the ability to act without internal interference. The trade is placed because conditions exist, not because the trader feels compelled. Excitement is a warning sign. When traders feel a rush before entering, it usually means risk is too large or expectation is too high. The mind becomes invested in outcome. Once invested, interference begins. Interference destroys execution. Fear and excitement are different expressions of the same problem. Both pull attention away from process and toward result. One makes you hesitate, the other makes you overcommit. Neither belongs in execution. The consistently winning trader aims for emotional flatness. Trades feel routine. Wins feel expected. Losses feel acceptable. There is no emotional spike worth chasing. This feels unnatural to most people. Human beings are wired to seek stimulation. The market offers endless opportunities for it. Fast moves, big candles, sudden reversals. These trigger emotional responses. The disciplined trader resists this pull. Perfect execution requires that your emotional state, before, during, and after, the trade remains unchanged. You feel different after a trade. Execution was compromised. This is why position sizing matters psychologically. Oversized trades amplify emotion. Even the best setup becomes unmanageable if the risk is felt too deeply. Neutrality cannot exist under emotional strain. A properly sized trade allows distance. Distance allows observation. Observation allows execution without attachment. Many traders confuse excitement with confidence. They believe feeling energized means they are aligned. In reality, confidence is quiet. It does not need reinforcement. Confidence shows up as patience. Excitement demands action. It whispers urgency. It encourages shortcuts. It justifies bending rules this one time. That is not confidence. That is instability. The market punishes emotional peaks. Traders who chase euphoria often give profits back quickly. The high fades, the rules loosen, the account pays. Consistent traders fear euphoria more than loss. Loss is manageable. Euphoria erodes discipline. When you feel too good, you stop protecting yourself. Perfect execution requires respect for risk at all times. Emotional neutrality keeps that respect intact. It prevents carelessness and overexposure. This does not mean trading without feeling. It means not letting feeling drive action. The mind can acknowledge emotion without obeying it. This skill is trained through repetition, entering trades without hesitation, exiting without regret, stopping without frustration. Over time, emotion loses its authority. Execution becomes mechanical, not robotic, reliable. Reliability is the foundation of consistency. Without it, edge remains theoretical. The trader who masters emotional neutrality no longer seeks excitement in the market. They seek precision. Precision compounds quietly. The market does not reward emotional intensity. It rewards those who can act the same way in calm and chaos. Perfect execution lives there. Fear is obvious. Traders talk about it openly. They blame it for missed entries, early exits, and hesitation. Fear feels like the enemy, so they try to conquer it. Euphoria is quieter and far more destructive. Euphoria arrives after success, a winning streak, a big trade, a period where everything seems to work. The trader feels aligned, sharp, unstoppable. This feeling is intoxicating. That is when discipline begins to slip. Fear makes traders cautious. Euphoria makes them careless. Fear asks questions. Euphoria assumes answers. One slows you down, the other speeds you up beyond control. Speed kills consistency. When euphoria takes hold, rules feel unnecessary. Risk feels manageable. Size increases feel justified. The trader believes they are finally in sync with the market. This belief is an illusion. The market has not changed. The trader's perception has. Euphoria shifts focus from process to outcome. The trader starts trading profits instead of setups. They protect gains emotionally instead of behaviorally. They begin to measure success by how much they are up, not by how well they execute. This shift is subtle but lethal. Under euphoria, mistakes are ignored, deviations are rationalized, losses are brushed off as noise. The trader believes they can recover easily because they have been winning. This is how large drawdowns begin. Fear may stop you from trading. Euphoria pushes you to trade too much. Both are emotional extremes, but only one convinces you that you are in control. That is why euphoria is more dangerous. Consistently winning traders treat euphoria as a risk signal. When emotions rise too high, they reduce exposure. They tighten discipline. They slow down. They do not celebrate with bigger bets. Celebration belongs outside the ma. Yet, the disciplined trader understands that the market does not reward confidence. It rewards accuracy and restraint. Confidence without restraint becomes arrogance. Arrogance invites punishment. Euphoria also weakens patience. Traders stop waiting for ideal setups. They believe they can make money in any condition. Standards erode. Good enough replaces exact. Edge disappears when standards drop. The market does not punish immediately. It allows euphoria to grow. Then it takes everything back quickly. Traders call this bad luck. It is not. It is delayed consequence. Fear teaches humility. Euphoria erases it. The trader who fears loss respects risk. The trader in euphoria underestimates it. Underestimation leads to exposure. Exposure leads to damage. Managing euphoria requires self-awareness. You must recognize when you feel unusually confident, energized, or invincible. Those are not signals to act more. They are signals to protect yourself. Lower size, reduce frequency, stick rigidly to rules. These actions feel counterintuitive during success. That is why most traders do not take them. The trader who survives understands that the goal is not to maximize one period. It is to survive all periods. Fear may slow you down. Euphoria can destroy you. Consistency demands emotional balance. Not the absence of emotion, but the refusal to let emotional highs dictate behavior. The market does not care how good you feel. It responds only to what you do. Most traders think position sizing is a mathematical decision. Percentages, risk formulas, account size. They treat it like a technical adjustment, something secondary to entries and exits. That misunderstanding destroys execution. Position sizing is psychological first, mathematical second. Your mind reacts to risk before logic ever engages. If the size is too large, emotion rises immediately, heart rate changes. Focus narrows, time compresses. You stop seeing price clearly and start feeling it instead. That is when execution fails. A perfectly planned trade becomes unmanageable. When size overwhelms the nervous system, stops are moved, targets are adjusted, decisions are rushed or delayed. None of this comes from the market. It comes from discomfort, correct Presidio. End sizing creates emotional distance. Distance allows observation. Observation allows discipline. When size is right, price movement feels informational, not threatening. Threat perception is the enemy of consistency. Most traders oversize because they want results faster. They believe bigger size means faster progress. In reality, bigger size means faster emotional collapse. The market does not reward urgency. When size is too large, every tick matters too much. Small fluctuations feel like danger. Normal pullbacks feel like failure. The trader becomes reactive, not deliberate. Reactive traders do not execute plans. They respond to fear. Correct sizing allows patience. You can wait through noise. You can let trades breathe. You can accept small losses without needing immediate recovery. This acceptance is essential. The consistently winning trader chooses size that feels almost boring. No rush, no panic, no exhilaration. Just manageable exposure that allows rules to function. This is difficult for traders who crave excitement. Excitement is often confused with engagement, but excitement signals that emotion is driving participation. Emotion distorts risk-reward. Risk-reward only works when trades are allowed to play out as designed. Oversized trades rarely reach their intended outcome because the trader interferes long before price decides. Interference is expensive. Correct position sizing also protects you during drawdowns. Losses remain small enough to tolerate emotionally. Tolerable losses do not trigger desperation. Desperation triggers inconsistency. Consistency survives only when losses are absorbed calmly. Many traders say they can handle risk, but their behavior proves otherwise. The moment a trade moves against them, they feel compelled to act. That compulsion is information. It tells you size is wrong. The market is not stressful by nature. Stress comes from exposure beyond tolerance. A trader who sizes correctly does not need exceptional discipline. Discipline becomes easier because the emotional environment is controlled. This is the hidden power of proper sizing. You do not need to fight your mind if you stop provoking it. The goal is not to feel nothing. It is to feel little enough that rules remain in control. When size is correct, execution becomes repeatable. Repeatable execution allows edge to express itself. Without correct sizing, even the best edge collapses under pressure. The market does not defeat traders through bad prices. It defeats them through unmanaged exposure. Quiet the mind by respecting size. Protect execution by choosing tolerance over ambition. That restraint is not weakness. It is professional survival. Most traders believe progress comes from action. More trades, more screen time, more involvement. They equate movement with growth and stillness with stagnation. The market punishes that belief. Edge does not decay because you wait. It decays because you interfere. Every unnecessary action erodes precision. Every forced trade weakens discipline. Activity feels productive, but it often hides avoidance. Waiting exposes truth. When you are waiting, there is nothing to blame, no execution to justify, no loss to rationalize, just you, your rules, and your patience. That silence makes most traders uncomfortable. Discomfort pushes them into action. Restraint is not inactivity. It is controlled selectivity. It is the discipline to ignore 90% of what the market offers and act only on what aligns perfectly with your criteria. The market is generous with noise. It is stingy with opportunity. Traders who act on noise feel busy. Traders who wait for opportunity feel bored. Boredom is not a flaw. It is evidence that standards are intact. The consistently winning TR. Adder accepts boredom as part of the job. They do not try to escape it by lowering criteria. They do not chase movement just to feel involved. Involvement is not edge. Edge exists in rarity, in precision, in moments where probability and risk align clearly. Those moments cannot be forced. Waiting preserves emotional capital. Every trade carries emotional weight, even small ones. When you trade too often, emotion accumulates. Judgment weakens, standards blur. Restraint resets the mind. A trader who waits enters trades with clarity. They are not reacting to the previous outcome. They are not fatigued by decision-making. Their execution is clean because it is not rushed. Most traders sabotage edge by trying to extract something from every market condition. They trade ranges like trends. They trade chop like momentum. They refuse to accept that sometimes the correct response is no response. The market does not pay for effort. It pays for alignment. Waiting also protects confidence. Confidence built on restraint is stable. Confidence built on constant action is fragile. One bad sequence collapses it. Restraint creates consistency. Consistency builds trust. Trust allows patience. Patience allows edge to work. Activity without purpose creates volatility in behavior. Volatile behavior cannot produce stable results. This is why overtrading is so destructive. It replaces waiting with urgency. Urgency replaces judgment with impulse. Impulse replaces rules with emotion. The market does not require your presence. It does not care if you trade today. Your account does. Restraint, a form of risk management. Every trade you do not take eliminates risk entirely. That protection compounds quietly over time. The trader who survives longest is not the most active. It is the most selective. Waiting is not wasted time. It is preparation. Preparation for the moment when ion actually matters. When that moment arrives, the restrained trader is ready, calm, focused, unemotional. Their edge is intact because it has not been diluted by noise. The market rewards those who know when not to trade as much as those who know when to act. Restraint is not passive. It is deliberate discipline, and discipline, not activity, is what preserves edge.